Good morning, everyone. My name is Sean Jude McCoach, and I'm the publisher of the Central Penn Business Journal and Central Penn Parent Magazine. Welcome to this installment of the Central Penn Business Journal's webinar series entitled Financial Commodity Hedging, Understanding the Basics. Today's conversation is brought to you by Huntington National Bank. Huntington Bankshares Incorporated is a regional bank holding company headquartered in Columbus, Ohio, with $104 billion of assets and a network of 966 branches and 1,848 ATMs across 8 Midwestern states. Founded in 1866, the Huntington National Bank and its affiliates provide consumer, small business, commercial, treasury management, wealth management, brokerage, trust, and insurance services. Huntington also provides auto dealer, equipment finance, national settlement, and capital market services that extend beyond its core states. Today's presentation focuses on product area within Huntington Capital Markets to assist in managing commodity risk. To learn more about Huntington Bank, please visit www.huntington.com. That's www.huntington.com. In a moment, I'll be turning the conversation over to this morning's presenters, Philip Brenckle and Darrell Fletcher. But first, a bit of housekeeping. All attendees are in a listen-only mode. The questions function is available if anyone has any questions throughout the conversation. Most questions we will save for the end. Our speaker will take as many questions as time permits. If a question is asked and does not get answered, it will be addressed offline via email. A recording of today's webinar will be made available soon after the conclusion of today's session on our website at www.cpbj.com/events. That's www.cpbj.com/events. A handout is also available in the handout section of your GoToWebinar widget of today's presentation. At this time, I'm pleased to welcome today's presenters, Mr. Philip Brenckle and Mr. Darrell Fletcher. Philip Brenckle is a Senior Vice President and Regional Market Executive for Central Pennsylvania, a Huntington National Bank. Philip has over 16 years of experience in commercial banking, having structured, advised on, and completed hundreds of transactions during his career. He formally opened Huntington's local commercial banking office in Central Pennsylvania in 2017 and currently leads all aspects of Huntington's commercial bank in the region. Prior to joining Huntington, Philip spent over 15 years at another large commercial bank where he distinguished himself as one of the top bankers in their commercial division. A graduate of Duquesne University, Philip earned a Bachelor of Science in Business Administration. He also received his MBA at the Katz Graduate School of Business at the University of Pittsburgh. He is an active community leader and resides in Hershey. Darrell Fletcher is the Senior Managing Director of Commodities, responsible for the launch and ongoing management of the Capital Markets Commodity Sales and Trading Desk for Huntington National Bank in Columbus, Ohio. He is responsible for managing the execution of commodity trading, marketing, and hedging programs to commercial and institutional clients for the bank. Darrell has over 24 years of experience in commodity and foreign exchange trading in both large corporations and banking. Prior to joining Huntington Bank, Darrell spent 13 years with Fifth Third Bank in Ohio, where he managed the Capital Markets Commodity Sales and Trading Desk. Prior to Fifth Third Bank, Darrell managed Alcoa's $9 billion commodity and foreign exchange hedging portfolio in Pittsburgh, Pennsylvania. A graduate of The Ohio State University, Darrell earned a Bachelor of Science in Industrial and Systems Engineering. He continued his education at the McCall School of Business at Queens College in Charlotte, North Carolina, where he earned an MBA. Thank you to Philip and Darrell for sharing your expertise with our audience today. If you both are ready, please take it away.
Thanks, Sean. This is Philip Brenckle. Good morning, everybody. I guess almost afternoon. Thank you for taking a few moments out of your time here on what I think is a rather extremely topical area, commodities, due to some of the recent geopolitical concerns, the trade wars, all the headlines that you all read. That's probably why you're here today. So hopefully we're going to present to you some tools that exist out in the marketplace to help you better mitigate and manage that risk if you are in fact experiencing it. Just a quick, you heard a little bit about Huntington. We're obviously new to the central PA market, but what you may not know is it's sort of a natural extension. We have a fair amount of branches, about 35 or 40 in the greater Pittsburgh area, and our corporate bank in the state of Pennsylvania, or commercial bank as we call it, has a little over $1.5 billion in commitments just in the commercial bank. That doesn't account for retail business banking, et cetera. in the state of Pennsylvania. So coming to Central PA and having a physical commercial banking office here in Lancaster is simply just a natural extension as we grow into Pennsylvania. We are, in terms of size, we're 104 billion in assets, which makes us in the top 25 largest banks. But the way we view it is we're sort of big enough to matter, but still small enough to care. So we welcome the opportunity after this. If you have any questions, whether it's about commodities or banking in general, don't hesitate to contact us or have us come out to your facilities and talk in more detail. Just a little bit about why Huntington came to this market. We believe our bank is really geared towards the size of companies that predominantly exist in the central Pennsylvania market. We are very interested in the industries that dominate this market. And the last piece is really we thought some unique products that maybe aren't as frequently offered by our peers in the market, commodities being one of those examples. We also provide other areas that we think are unique, such as our private placements and junior capital teams, as well as Huntington Mezzanine Finance. So being able to be a single source lender. We have some international capabilities to finance international growth. We've got a great healthcare team. We just did a survey, and a number of folks responded that they wish their banks could assist them with managing healthcare costs. We have an agency as well as local partnerships in Pennsylvania to help clients in those areas. So those are just a couple of examples where we can add value, as well as technology asset finance, which is pretty unique. So think of that as really anything that's not equipment, so iron, Caterpillar equipment, that type of thing. Any assets that aren't like that, we also had a number of folks respond that they needed assistance in financing specialty assets. So those are just a couple of reasons why Huntington came to this market. But really, I want to make sure we have the most time to talk about is the commodities markets and what products and tools are available out in the marketplace to help you manage that risk. So at this time, I'm going to turn it over to the gentleman that manages that business for Huntington, and Darrell Fletcher, and let's begin the presentation.
Great. Thanks, Sean. Thanks, Phil. Appreciate it. Yeah, certainly the timing is good on this conversation. It's been an interesting month or two with the sanctions, particularly in some of the trade talk. Overall, I've been doing this for a while. It kind of tends to be a lot of noise on a daily basis. You try to keep track of kind of what the basic underlying fundamentals of each commodity are, but it certainly has been an interesting time. Today, I'm going to try and go through some of the basics and just the fundamentals of what we do in commodities and on the financial hedging side for what's available, give you an idea of what's out there. From Huntington's perspective, we cover energy, metals, and to some smaller extent, agriculture and soft products. On the energy side, we deal with a lot of producers, and this is one of the businesses that Phil had mentioned where we have a national presence. So we are certainly busy in the region here today in Pittsburgh, but across the other basins when you get into Denver and the Gulf Coast and places like that. So we have quite a bit of activity on the producer side. That would tend to be a sell-forward type activity. We deal with some refiners. And then the other area that the energy side is really prevalent in is on transportation and shipping. So on the buying side, you deal with a lot of diesel fuel, gasoline, and natural gas too, in a lot of applications. On the metal side, which we deal with a lot up here in the Midwest, we deal with some client base in mining, some steel, a lot of aluminum and copper, and that is also a pretty big piece of business for us. Some of that's driven by the automotive market. Some of it just happens to be just straight manufacturing. And the goals there tend to be different. There's a lot of inventory hedging and forward buying both. And like I said, on the ag and soft side, we're rather new to that. And that also can be a revenue type fixing for prices or on the cost side for purchasing price. Overall, our mix tends to be, to date, notionally, we're about 70% energy, probably 20 to 30% metals, and then some other odds and ends. From a trading basis, it's almost flipped. The metals trading tends to be, or the hedging tends to be more frequent, pretty much daily, and a shorter tenor type hedge than, say, energy would be, which those tend to be longer dated hedges. Some general points I just wanted to go over on kind of what financial hedging is and what it isn't. The commodity trades are to mitigate price risk. This can be on the revenue side or the cost side. But all the hedges, basically you're hedging against some kind of physical exposure you have. It's not meant to be any kind of proprietary type hedging or speculative. It should be the best way to look at this is to view it as an insurance policy. Typically you're stabilizing costs on the buy side, or you're selling forward some kind of a revenue stream. Or there can be shorter dated selling on inventory where you're really just protecting your assets that are on the floor for a certain period of time. That's most common in the metal area. The one thing about financial hedges that's a big advantage is they can be customized to match or mitigate the risk a lot better than, say, a futures contract. This has to do in terms of size of the contract and the customization of the timing and or getting into options or swaps. So there are a handful of advantages over futures type trading. And also there's limited or no margining on this type of product. But again, to review, typically you're stabilizing a cost or you're buying forward something on a cost to protect margins. You're stabilizing revenue to sell forward a revenue type stream. This is more common in the producer area. And or protecting an asset on the inventory. We have metals producers or metals type manufacturers that are both selling forward in the front and buying forward longer dated hedges for their customers on fixed price, but they still have this inventory hedge where they have an asset on the floor.
Darrell, I think is really honing in on the key point of hedging here, which is, this is no different than you would often look to do a fixed rate loan, or you would look to have certain, coverages in your health insurance that give you a fixed price and allows you to have certainty in your cost structure, and you're trading that for the variability in the market where it could go down and work in your favor, but it could also go the opposite direction and hurt you. So really what this product is designed to do is to give you budget certainty. And if you think of it like just like you'd get a fixed rate on a loan or how you buy an insurance policy, I think that's very applicable in understanding the product. Agreed.
And getting into the next slide on kind of why you hedge your price risk, and I'll kind of go off cue here as we get through this slide. But basically, you're trying to hedge a portion of your exposure. It depends. I've seen a lot of strategies in terms of over the years, whether it's large corporate or middle market or producers, different strategies on what they're trying to do, and they all typically make sense. Everyone has different goals. It could be trying to hit a budget number for the next year only. It could be a long-dated exposure that it always exists, and there's no way to pass pricing through either way. So there's more of a consistent rolling hedge. I've seen year-over-year type hedging strategies. And as long as they're in line with the business goals and what you're trying to get done in the business and not get too hung up in actual commodity hedging, I've seen a lot of different strategies, and they all work right if they're lined up right. Again, I'm talking about securing strategic and long-term pricing on some of these. But one of the things I want to spend some time on, I'll go off script here a little bit, is kind of how I look at hedging, because I actually come from a hedging background, working here at Alcoa in Pittsburgh a long time ago. But I would say 80% of the work is knowing your exposure. Step one, I always say, is kind of know your exposure, understand it, spend some time around what the amounts are and how long it is. And then the next part, number two, I call kind of so what. Understand that risk, know what it means. I talk to a lot of people, and I'll say, you can hedge or not hedge. Either one can be correct if you want to hedge or not hedge. But understand the risk. What does it really mean on a dollar per share basis, on a margin basis, year-over-year type of growth? So understand, know the exposure, measure it out, do some risk assessment around it, and then make your decision. Again, we've got about 80% of the work done there. Whether you want to hedge it or not doesn't really matter. At that point, it's just hedging accordingly, and the last point would be just staying the course on whatever hedge strategy you decide to go with that makes sense for your business.
I think another interesting point, using a real-life example, a lot of times you may have a purchasing team that's working underneath you, or a quoting team that's putting bids together. Let's say you're manufacturing something out of steel, and you're asked to give a quote to your customer. We've heard stories or scenarios where people within the company who are, trying to protect the company know that the prices are moving. So they're adding, 10 or 15 or 20% onto that quote because they're, in their eyes, they're doing the right thing by the company because there's volatility in steel right now. But, the reality is they're making their product potentially cost more, and they could be chasing customers out. Where if that purchasing team or that quoting team knew that the company had fixed pricing out there and knew that it didn't have to build in a margin, then they could put the most aggressive price on the table and know that that was in fact, a good thing for the company to be at this level and know that they don't have that commodity risk. So it also empowers, purchasing teams and or quoting teams to know that they don't have to build in a fudge factor that could make their price not as competitive. So Darrell, quick question. Do people generally hedge, like if they, let's say you're a steel manufacturer, do they generally hedge 100% of their steel risk? What do you see out there?
Typically not. No, that gets kind of back to knowing your exposure in the hedge strategy. Typically not. It depends on the business too, but most of the hedges we've seen, if you think about hedging, if you get to a 50% hedge of the exposure, you should consider yourself risk neutral. Hedging 0% of a risk that you have or hedging 100% from a risk profile is the same. You're either taking one view or the other, but a 50% hedge tends to get you risk neutral. Now, I would say most of our hedgers are probably, if they know the exposure well and they're very exposed to it, probably get up to that 75-80% hedge range. It depends on the business, though. Across different industries, you can have hedges that are higher. Sometimes transportation is very well known, and they want that all hedged, and so we'll get up in the 90 up to 100% type of hedge. But then again, you have people that are dependent on the industry and the goals are just really trying to neutralize it, and they do have that risk, so they'll get to 50% hedged, so they have half exposed to the market and half locked up. So it just really depends on the industry.
Yeah, and you could also run into a scenario like you said, where somebody has a long-term cost, it's very specific, and so they want to hedge 100% of it. So I think it's a broad spectrum, but I think that the general takeaway is that typically people are not literally hedging their entire position, but to hedge no position and have no fixed price, you've basically taken the opposite risk. You're taking on 100% of the risk.
Yeah, to your point, the contract type basis, where we see this sometimes in large scale road type work and things like that, where there's a large project going on, it's very specific to a bed, and it's known to be like a 5-month exposure, and they know exactly what they're going to burn in terms of gallons. They'll hedge pretty much 100% of that because it's tied to a specific bid with locked-in pricing.
Yeah, great example of fixed price construction contract or something like that, where you have a tremendous amount of commodity exposure, but you know exactly what you're going to buy. That could be a potential ideal scenario to employ a tactic like this.
Yeah. And speaking of diesel, since we kind of got on that example, we can move off to this next chart now. Looks like slide 5. So we'll get into a couple real-world pricing graphs here. I think this is ULSD, ultra-low sulfur diesel, which is pretty much the most common diesel we deal in. This is a 3-year chart. Just a couple of notes here to go through in terms of volatility. You see the period at the end of 2015 and going into early 16, we had about a 45% move down, 53 trading days on diesel. This happened to be, a lot of you may remember, well, if you're in the oil and gas industry, remember it well, when crude oil had gotten down in the $30 a barrel range. So diesel and gasoline are typically, all things being equal, very tied to crude oil. So that's what that move was about. We kind of bottomed out there the end of 15. I think crude might have bottomed out a little bit after that, actually. And then we got back into a more steady state through 16 and 17. Note that the 5-year average on diesel is $2. This is a 3-year chart. We kind of stabilized in there, but still kind of below the average. And then late last year, we started to see a lot of support in the crude market. A lot of that had to do with things that are still being talked about. They will be talked about a lot tomorrow. The OPEC production cuts, when they really started to come to fruition as opposed to just talk, and those production cuts were being held to. And demand, fuel demand's been really good globally since last year. Just been good global growth across the board. So we've had a steady kind of move up here since June of 17. We started getting into driving season then. And these are the kind of moves we can have. We had a lot of hedges that got on in time, but frankly, I'd say there's probably a lot of the fuel hedgers that typically hedge are probably a little under hedged from where they want to be going into 19. The aluminum chart on the metal side, as you can tell, this is a 1 year chart here we've got on us, but aluminum tends to be a little more stable. As you can see, back in April, we got way out of the norm. This had to do with Rusal sanctions on Russia. We were having 7% increases a day in that time frame. I think we had a 25% move on 9 trading days. That's very, very much out of the norm, especially in the aluminum market. On this chart, we're in dollars per metric ton. Note that 2200 level is about $1 a pound. But again, I just say so often we get the call when it's too late. We'll get a call about certain things. And that's what I'm saying. If you know these exposures up front, do the analysis, understand what they really mean, do some sensitivity around it. People tend to get complacent when prices are very stable. I mean, we can have, things happen we can't control. So this is a really good example of what we dealt with in April and into May. Things have subsided here, but aluminum is still fairly strong. Plus, we have the Midwest premium on aluminum now also that's prevalent in this area, and it's at a very high level, probably around 18, 19 cents a pound on top of this. Okay, moving on, decoupling physical from financial. As companies get more sophisticated in their hedging and they really know their exposures and they're meaningful, I just wanted to spend some time getting into this, where the companies will start to separate the price from the supply. So when you decouple the physical risk from the financial risk, your physical risk is actually a risk in terms of actually getting material and getting it and moving it physically. And then they'll decouple and they'll look at the financial price risk separately and they'll run their hedge program on the financial risk. But again, this happens typically when customers and companies get bigger and get a little more sophisticated. They may have multiple plant locations, and they'll be able to get some price uniformity, and they'll pull that exposure together and have a global financial type risk program on that. Oftentimes, you're hedging with a higher credit entity, particularly with a bank, and you also can avoid narrower physical sourcing. When your financial risk is not tied to your physical supply, you can still cover your financial risk, but be able to buy from multiple vendors physically in the open market. And again, I think I've touched on this from a financial hedging perspective. You have the ability for customization of the products and longer tenor.
And Darrell will go into specific examples of how this all works, but I think the most critical takeaway point of that slide, and it's a very critical takeaway point of this presentation, is we as the financial hedging entity are not involved in the physical product. So we're not going to be getting invoices from you or taking information around what you're purchasing. You know your volumes. You're going to hedge the volumes, and we're going to help you control the price side. What that allows you to do is then go out into the physical market and procure the product from anywhere at the best price, so that you've got the both availability in the open markets, but then being able to control your price on the back end. So Darrell will show you how that physically occurs, but it's a big advantage to you as the buyer or seller of this commodity to be able to separate those two, as opposed to the opposite would be, think about calling up the gas company and saying, hey, can I have a 3-year fixed price agreement? So you're getting the lock from them, but you're also buying the product from them. So therefore, you're not able to access the free market as much because you've coupled those two things. So that's a very important point. But Darrell will now go through a couple of option structures that are out there, and then show you how this physically works in terms of the dollar movement.
Yeah, on the financial hedging side, you have some more options certainly than if you were getting your fixed pricing through physical, because typically that's what you get is just a fixed price. And again, you've tied to your physical provider. The most common, I'll just go through from the consumer's view on the buy side, the most common hedges, and really there are other products out there that get more complicated, but it's not needed. I mean, in the hedging side, in most, I would say 90% of the people we deal with, you're really just blocking and tackling here. So fixed price swaps on the buy side, you're buying forward a certain price for a certain time on a certain volume in those times. And then the same thing on a call. If you're buying a call, that is simply put buying insurance. If you're a buyer, you're basically buying protection that prices won't exceed a certain level. And that is the truest form of hedging, really, is just to buy the call option. The downside of the call is the upfront premiums. Those premiums are paid for upfront. But as I say, you don't really hope to use your home insurance someday. So it's kind of a similar situation. Consumer collar, you can zero cost out that premium where you buy the call, but that premium is offset by selling a put. So you end up in a range of prices. And a lot of that's probably most common. Certainly, gas and oil producers have a producer collar. It works well to be in those ranges. On the buy side, over the years, I've seen a lot of effective collaring in the fuel side, because I'll have a lot of customers say, hey, I can deal with diesel fuel going up 25, 30 cents. I can't deal with a blowout in the summer of $1. So that's where these consumer collars work really well. You're in a range, but you're not in a specific price swap where there's a lot of gains and losses. Walking through one of the hedge mechanics on diesel, in this particular example, this is pretty straightforward. It looks like there's a specific time period on this example where they're going to do a 100,000 gallon hedge of diesel fuel for June to October. This can be common in contractor work where there's a road project or something where they have a large amount of work that will be done in the summer. And again, this could be like the example we talked about where it's tied to a specific bidded project. In this example, it looks like they put in a hedge of $2 a gallon on NYMEX heating oil ULSD. If $2 looks cheap, that's because the NYMEX contract, that index is a wholesale price. And that's probably 70% of what we do is wholesale diesel across all the diesels. Here, the customer would pay a fixed price to Huntington, $2 a gallon, 100,000 gallons per those months. You do create 5 different settlements. So you'll have a financial settlement June, July, so on through October. It looks like there's 5 months there. And we pay the market price back. And again, on these diesel and gasoline hedges, most of them are based on the average daily rate. So it's the settlement of the index on the daily settle. So there's however many settlement dates there are in that particular month, whether it's 20 or 21. So it's a daily rate. And what you're trying to do there is mimic your physical exposure as best possible. So prices change daily, so you're trying to take the average of that month and have a settlement against that. Now, again, the net effect is the transaction brings the customer back to the fixed price. And the mechanics on this, to walk through these, clearly this is an example, so these settlements haven't happened yet. But as an example, June, we had a fixed price for all 5 months at $2. If the June settlement came in at $2.03, there'd be a 3-cent gain per gallon. Settlement to the customer will be $3,000. That would happen at the end of June, first couple business days of July, and then so on and so forth. You can see July there was a settlement at $198 of the monthly average prices, so there was $2,000 loss, and it goes on. The net effect here, you're stabilizing your cost on diesel for this particular project back to the $2 wholesale price. And then walking through an aluminum example, this one it's a common situation. I noted here on this example, this particular aluminum not a producer, but basically an aluminum manufacturer. It looks like they have inventory risk. So this is the example where they might be selling forward 2 months of inventory, but also have longer dated fixed price contracts where their customers want to come in and lock something up. This particular hedge is 100,000 pounds a month, January 18 to June 18. buying forward a fixed price swap at $1.15. And this index is the LME Aluminum Index, which is the London Metal Exchange Index. You can walk through some of the details of what the agreement is, but we've touched on this. What you're doing in the physical market, you're continuing to pay your physical and get your physical suppliers in the open market, and now you've decoupled the two risks. In case there was any issues with a physical supplier on supply, you'd be able to go to somebody else to get aluminum, and you've got the two risks decoupled. Again, net effect of this transaction brings the customer back to the fixed price. In the table, these are pretty much actual settlements except for June. This LME was a fixed price $1.15. You can see the settlements in January settled below, and then we had that move in April where it spiked up in April, and they had a settlement 123. They're back in the money in April and May with the gains. You can kind of see the net effect and then where we're starting to work through in June right now.
So I think now we're just going to move to a couple of just questions around where sort of the general areas or triggers come in at, and then just a little bit more information, and then we'll be opening up the floor to questions. So please continue to think of any questions. It points here a little bit technical, so we apologize for that, but that's why we want to leave a lot of time for questions. But I think Darrell's going to run through a list of sort of common questions that we see or triggers of when something like this makes sense and when you should really be addressing this risk.
Yeah, this gets back to some of these questions and triggers are pretty open-ended, but it really gets back to that first 80% of the work, knowing your exposure. In terms of, it can be gross margins, what's causing that, getting into commodity exposure you're most worried about. Usually business owners know what matters. If a particular price is going up or down are going to hurt them. And then you can start to think through the hedging program in terms of what is the exposure, really understanding that, doing some assessment around the risk and what it really means. But what you'll have to get a good handle on in the upfront stages of that is the total monthly exposures and your ability to pass through or not pass through, and then you can kind of go from there in the analysis. Some of these next slides are really just reference slides. This is an onboarding checklist that we get into at the bank in terms of onboarding the customer. I don't want to get into the details there. The next one, though, the minimum hedge volume, is a good reference slide. Gives you an idea of the monthly exposure to do financial hedging on the gasoline, because we get this question a lot. And if someone comes back to us and say they know the cost or how much they're spending on diesel or gasoline, we can get to a pretty good idea. But from getting the financial hedge on a monthly basis, these are pretty much the minimums we have per commodity. And these are our most common commodities. I would say gasoline, diesel, natural gas, crude oil on the energy side, and on the metal side, our most common hedges are by far aluminum, copper, steel, and then also we get into some nickel and zinc. And you can see what those monthly minimums are for those. Okay, the next slide is just our desk contact information. We're at the headquarters in Columbus, at the trading floor there for capital markets. You can see our team listed there and our contact information. I think we've also put in a reference slide on common terms, which is good to have if you have any questions on some of the things we've talked about. But certainly we can answer any other questions.
Darrell, before we jump to the questions, I think one of the most common questions that I get out in the marketplace is, if companies do have a fair amount of exposure to commodities, a lot of them are, leveraging futures contracts, trading, directly in a brokerage scenario. How is trading with a bank desk different than trading with a brokerage desk, or trading just those straight futures contracts?
Yeah, probably the biggest two differences, trading with the bank, when credit's established, there's little or no margining required because it's typically our collateral is cross-collateralized against a loan. So that's one of the big relief points. We have some larger companies we deal with that do a combination of both. They'll actually it could be seasonally driven or just notional size driven, where they have some cleared contracts or notionals, and these are bigger companies, and they will seasonally move out of some of those and use more OTC type contracts with us just to avoid large margin potential. That's the one big advantage. The other advantage would be the customization. So when you're doing the futures contracts, it is a very set notional. It is a set notional amount in expiration. In the example of diesel, I mean, if you're buying a diesel contract, that expires on a specific date and a specific amount. That's not mimicking, in most cases, what you're really doing, in terms of what your exposure really is on a daily basis. Because you're not pricing physically all of your purchases on a specific date. It can be an ongoing exposure through the month. So that's why our financial hedges on diesel tend to be an average rate. It's the same thing in aluminum. We have average rate type settlements or single day settlements, just depending on what the actual physical exposure actually is.
Great, thank you. So that I think ends the formal part of our presentation. Sean, we'll turn it, I guess, back over to you for any questions that came in through the chat or of course, on the line.
Yeah, great. Thanks, Philip, and thank you, Darrell. I learned something new on every one of these. I'll tell you what. Like, I had no idea going in, and I've just enjoyed following along. And I'm glad you put in the table of contents for someone who doesn't know much. I'll certainly be looking at those. So thank you. So a couple questions that have come through. The one I think is probably most relevant at this time. So how is hedging with a bank different than hedging directly with a commodities broker?
Yeah, that's what we just touched on in terms of the two biggest advantages really are the customization of the hedge type you can do with the bank, and the other one is the lack of margining needed versus hedging with a broker.
When you trade with a broker, you're likely in most scenarios going to have to post 100% collateral, whether that be in the form of cash or a letter of credit or some very liquid security. The brokerage firm is not able to take the financials of a business and underwrite it for credit risk. Whereas if you're hedging on a bank desk, we've got certainly a lot of credit people here that can review companies' credit profiles and determine if there's a lesser requirement or potentially even no requirement at all associated with extending the credit that occurs just naturally. When you enter into a futures contract, we buy a contract for you, whether it's a broker or a bank. We have to settle that contract whether you give us the money or not. So that's where the credit risk comes in. And so when you're doing that with a brokerage shop, you effectively have to give them all that cash early on or some large percentage, because they're not going to be taking the credit risk. That they're not in the business of taking credit risk, they're in the business of trading. So the benefits to working with any bank desk are that not only can we underwrite the credit risk, but we can also perform the trading as well. So good question, and thank you for allowing us to clarify that a little further.
Yeah, and it can be cumbersome in terms of the margining agreements, because you have initial margin up front, and then you also have the variable margin. And those costs, those margin costs can be large, and so you have a daily tracking mechanism you have to go through and reconciliation too.
That's interesting. Thank you. The next one I find interesting is how much exposure to a commodity should a company have to actually consider it for hedging?
Yeah, going back on a couple of those slides, I think we had the minimums in there in terms of the ability to get the financial hedge off. But this, again, gets back to that groundwork going up front as to what the exposure is, like getting a handle on how big of an exposure it is and what it really means. Certainly, if it's, you do the analysis, you do some risk analysis around what ifs, and if that gets uncomfortable, if our margins, if a certain commodity, say diesel, moves up $1 a gallon over the course of the year, what will that do to our margins and our cost structure? And if it's meaningful enough and it's at the minimum hedging levels, then you certainly start to look at putting a hedge program in place. But you really have to get your handle on the exposure, the monthly volumes around it, and then simply knowing what it means to your business. It gets back to the kind of so what question. And different companies look at it different. It can be, again, the effect per share. It can be a budget lock type situation they're trying to attain, or just maintaining some margins.
Yeah, I think a good rule of thumb is if in the past you as a company have ever sat down and looked at financials, perhaps you were even reviewing them with your bank, and they said, well, geez, what happened here? And your comment was, well, we lost a little bit of margin because, fuel prices are rising, or steel costs are up, or, vice versa. We sell steel and steel went down in price. So if you're sensing that when you're talking about your financial results, you're referring to volatility in a commodity, you're likely a very good candidate to better explore hedging, and because if it's affecting your bottom line in a material way, then you likely have an exposure. But certainly you can also use that chart of sort of minimum volumes that's usually if your volumes are smaller than that, it's not if you're not going to be in a situation where it's going to move materially in your financial statements. So it's likely something that there are bigger fish you have to fry other than commodity risk. But if you are experiencing that, or you are moving those minimum volumes, whether it's with us or any provider, you should be addressing this risk, because Darrell knows so many of these commodities for a while were flat, and interest rates are a perfect example, which is all, interest rate is a commodity as well. It's money as a commodity. LIBOR was 30-some basis points forever, or 20 basis points for 6, 8, 9 years, and nobody thought, it almost kind of started to feel like it was a fixed rate, and people got, kind of used to that. Well, now we've seen a lot of rises in the interest rate. Same thing. All of a sudden, trade wars come, and what sort of felt like a very fixed price now all of a sudden is at the top of somebody's mind. So if those are the scenarios you're running into, you should be consulting with an advisor on how you can manage that risk.
Excellent. Thanks.
Phil, thanks.
Yeah, I have something here, kind of a two-part question for myself, actually. I think the audience for our webinars are normally looking for some takeaways. So why don't we spend a couple of minutes on some best practices around a sound hedging program, and even some common problems that people face. Sure.
The most common problem, I'm glad you asked that, because it's something we spend some time on. It simply gets down to inconsistency. Again, if you've gone through the work to understand the exposure and you put a program in place, you need to stick with it. In any good sound program, hedging program, there will be gains, there will be losses. It's a hedge. I mean, you're hedging for a specific reason against the physical exposure. So again, I've seen really good programs put in place that were long dated, on a long dated exposure, that we're simply not stuck to because someone changed their view within the company, and that you really get away from focusing on why is the hedge program in place in the first place, as opposed to trying to outguess the market. So that is the biggest problem by far, is just inconsistency in a hedge program that you put in place. They don't have to all be the same because it depends on your business, whether you use options, whether you hedge 12 months, whether you hedge 36-month rolling hedge horizon. And that gets into the best practices. I've seen large corporate programs for a long time. I've seen middle market programs, producer programs. The best practices that I've seen over time you tend to have a longer hedge horizon, meaning you don't keep your view so short, because commodities have pretty big moves pretty quickly. So if you're going to put the hedge out there and the exposure is known and it's ongoing, that hedge horizon typically is 36 months and it's rolling. So as the quarter rolls off, you open up your next quarter out there, and what would be the 39th, month, 39th, 40th going out, and you keep your hedge horizon long and rolling. So you don't want to I've seen a lot of people come in and they have an ongoing exposure every year, it doesn't change their ability to move it through. But they'll come in August, September, October because they're simply fixing their budget for next year. And then they'll say, well, that's not what we're budgeted for next year, the pricing that's available. So to have a longer dated program, consistently layer on hedges into that horizon, you can get to your budget period in October, whenever that might be. And from a conversation inside your company, you say, well, we have 70% of it for next year fixed here. That's our budget, rather than having arguments or conversations around where you want it to be versus where it is. The other best practice, some of the larger programs, is using optionality. A lot of the better programs I've seen, whether it's large corporate or in some of the producer areas, typically use a combination of swaps and collars or swaps and some kind of options. And there's been some pretty good case studies written on that, actually. But that tends to be in really larger exposures. And then again, this point of having a longer dated view, keeping your hedge horizon open to roll over.
And I think one of the challenges, like Darrell said, if it's a newer concept for you, using interest rates, that tends to be something people are pretty familiar with. They lock into an interest rate, and they put it away, and they never really think about it ever again, because hedges are constantly settling. It sort of allows them to always look at the losses and the gains, but they wouldn't go back and look at their interest rate and say, geez, we locked in at 4.5%, and the floating rate hasn't moved, so the fixed rate isn't working in our favor. Let's get out of this hedge immediately, right? It's typically not a conversation that you see because your interest rate is not settling every month, and so it's a little bit of a learning curve, like Darrell said. You're not going to win 100%. You're not going to likely have every hedge be in the money. You would become a commodities trader if you were able to perfect that and make a lot of money. The idea is to really work towards a budget number that you as the company know you can make a profit in. And Darrell actually came from a foreign exchange background, very similar circumstance. You're selling something overseas. You just want to maintain your 15% margin or 20% margin or whatever you priced into the job. You're not trying to make money on, the currency movements or anything like that. What you care about is making sure you get the same 15% that you would get if you were doing that project in the United States. Commodities are the exact same thing. You want to set that budget rate and then work hard to, hedge into that budget rate, and then you've locked in that protection. But the ongoing settlement, sometimes if you've never done it, can make it feel like, well, geez, we lost this month and we only won that month. That can be a little bit of a different mindset for people until they really understand and take the long view, as Darrell said.
Excellent. So we have one more, and then we'll take final thoughts from both of you. So the final question today, I think, is the why not? So why do typically companies not hedge commodity risk? And then why don't you give us your final thoughts then after you wrap up?
On the why not, there's probably two camps there. One camp would be the company that really kind of haven't done their homework around it. We mentioned this, where prices get very stable and low, and they just don't worry about it until it's too late. So they just haven't really spent the time to do the exposure. And I think Phil touched on this in terms of, you want to get ahead of it, because some of these charts have shown the spikes come out of nowhere for reasons, that we've never anticipated. So that would be one reason they don't, and then they never really get around to it. And then the other one would be they've done the analysis, they understand the exposure, and they've said we can live with it, or we have ability to pass it through, or it's not meaningful enough, so they just don't. They may have that exposure, but it's not meaningful to the business, and that's a sound decision.
Yeah, and and then I would throw one more out there, Darrell, and we've seen it a lot as we've entered into this market. A lot of people just are not aware that these tools exist, right? So their assumption is, I just have to take the risk, and/or I try to control it the best I can through my suppliers, and that's how I manage it. And it's not a case of they don't want to do it. It's just they're not aware that the tools are really out there for them. So that's sort of a third example, and was obviously one of the reasons we wanted to hold this webinar, to educate as many folks as we can to say, look, these tools are available out in the marketplace. Huntington is one of a couple large banks in the nation that offer this program, and obviously there are brokers through the futures contracts, et cetera. But really, it's probably not knowing and or just taking on the risk is the big one. Darrell, I'll turn it over to you for your final thoughts, and then I can kind of close up on today.
Yeah, I'll just kind of review some of the things I've said. Final thoughts, this has been a good month or two to have this conversation because of the volatility in the market. So it really gets back to this has been a good example of the things that can happen that are very unforeseen. So I would just get back to kind of looking at the exposures you have, understanding them, knowing what it means, do some sensitivity around it if you don't have a program in place. And then certainly contact us if there's something of interest.
Yeah, and I would say, Sean, from my side, the key takeaways are to remember that options do exist to decouple the physical product from the actual price point, which I'm probably you're sick and tired of hearing us say that, but I think that is what the largest producers in the world of these products are definitely using these same products. So that producers of the commodities are using these products. So that decoupling, remembering that this is about budgeting and creating a fixed price for yourself and creating certainty in your business. And perhaps in some cases, for the example that I gave, is creating certainty for your employee base that might be, charged with pricing and quoting and, feels very uncomfortable putting a 30-day quote out on a piece of steel that they're afraid the price might go up 15% on, and then they've made a mistake on behalf of the company in terms of how they've priced things. So really working towards the budget and the too late component, I think is definitely something to remember, right? You don't want to start these programs and have these conversations when the commodities are going wild and either rapidly rising or rapidly falling, because it's sort of like trying to buy insurance when your house is on fire, right? So it's not gonna be as effective. So the key to do these things are when times are good, and or there's not a lot of volatility, and really getting it in place and understanding it and doing all that, as opposed to sort of waiting for that scenario when if you're a trucking company, diesel prices go up $1, as Darrell said, and it's like, well, geez, we better do something about that. You want to get in front of these things, and it's something that needs to be thought of ahead of time, as opposed to a spur of the moment conversation. So those are my final thoughts, and certainly on behalf of Darrell and myself, we know everyone's time is extremely valuable, and we are what stands between you and likely eating lunch. So hopefully we can give you just a couple minutes back here at the end of the day. But please don't hesitate to contact myself or Darrell or anyone on our trading team if we can assist or answer any further questions. And certainly thank you to the Central Penn Business Journal for all their hard work to put this together today. They've been a fantastic team to work with. I couldn't have found the process any easier, so we appreciate their partnership and all their hard work to help us here today.
Well, thank you once again, Philip and Darrell, to everyone at Huntington National Bank for lending your expertise and insights into the topic today. I hope that everyone on the line has enjoyed this time as much as I have. I think the only hedging I've ever done is the 1 and the 1A horse. I don't know. So I think I learned something a little bit today. So, and I hope that you all have at least 2 or 3 takeaways that you can implement into your own portfolios. Thank you to everyone who asked questions. Again, if we did not get to your question, or if you think of something after the fact, please just let us know, and either Philip or someone from Huntington National Bank will get back to you offline. At this time, the call is now ended. I hope everyone has a great rest of your day. Take care.